The financial world just witnessed something extraordinary, and most people have no idea it happened. While you were celebrating the new year, while markets were quiet and traders were away from their desks, a seismic shift occurred in the precious metals market that signals we're approaching a moment of reckoning unlike anything we've seen in modern financial history. What transpired on January 2nd represents not just a significant market event, but potentially the beginning of a transformation in how precious metals are valued, traded, and understood by both institutional players and individual investors. 3 separate communications have surfaced from the banking sector, all dated January 2nd, transmitted between early afternoon and early evening Eastern Time. These internal messages reveal that major financial institutions accessed Federal Reserve emergency credit facilities totaling approximately $24 billion. The stated reason? To address liquidity concerns stemming from derivative positions in precious metals markets. This wasn't a routine transaction or a scheduled lending operation. This was emergency intervention by the central bank to prevent what insiders described as potential systemic stress. The magnitude and timing of this intervention cannot be overstated, as it represents one of the largest single-day deployments of emergency liquidity for commodity market stress in recent memory. Understanding what this means requires stepping back from the technical jargon and seeing the bigger picture. When well-capitalized banks that are supposed to be pillars of financial stability suddenly need emergency funding from the Federal Reserve on the first trading day of the year, that's not business as usual. When that funding request specifically mentions derivative exposures in precious metals, and when it happens immediately after China's export restrictions on silver took effect, the connection becomes impossible to ignore. These are institutions that have sophisticated risk management systems, teams of analysts monitoring market conditions, and regulatory oversight designed to prevent exactly this type of crisis. Yet here they are, requiring emergency support from the central bank. The timing tells us everything we need to know. China's new export licensing system became active at the stroke of midnight Beijing time on January 1st. That date was a market holiday in the United States, so there was no immediate price reaction, no trading activity to reflect the reality of what had just happened. But when markets opened on January 2nd, traders who had been away from their desks returned to find a dramatically altered landscape. Silver prices that had closed the previous year around $72 per ounce opened with a significant gap upward, reaching $79 and climbing to $84 by mid-morning. This wasn't gradual price discovery or normal market movement. This was a gap opening that immediately put pressure on anyone holding short positions. For institutions holding short positions in silver, positions established when prices were in the $60 to $65 range, this rapid price movement created immediate and severe financial stress. A short position means these banks had effectively bet that silver prices would decline or remain stable. Instead, they faced the opposite scenario, with prices surging more than 20% in a matter of hours. When you're short, thousands of contracts representing tens of millions of ounces, even a $10 price move translates into hundreds of millions of dollars in losses. The mathematics become brutal very quickly. A $20 adverse move across 50 million ounces equals $1 billion in losses for a single institution. The communications that emerged from these institutions paint a picture of coordinated crisis response. The first message, transmitted mid-afternoon, came from a senior risk officer informing counterparties that the institution had secured Federal Reserve emergency liquidity to ensure operational stability, given recent volatility in commodity derivative markets. The language was carefully chosen to project confidence while acknowledging the need for extraordinary measures. References to precautionary steps and maintaining adequate liquidity buffers revealed the underlying tension between managing actual risk and managing perception. Every word was calculated to reassure without admitting the full severity of the situation. What makes these communications particularly significant is their explicit acknowledgement of concentrated exposures in precious metals, futures, and options contracts. This isn't about general market volatility or typical trading fluctuations. These institutions are directly stating that their silver and gold derivative positions have become problematic enough to require central bank intervention. When a major financial institution tells its counterparties it needs Federal Reserve support to meet margin calls and settlement obligations, that's an admission of being caught on the wrong side of a major market move. It's an acknowledgement that without external support, they might not be able to honor their commitments. The second communication, sent roughly 90 minutes later by a different institution, offered similar themes with slightly different framing. This message referenced unprecedented volatility in precious metals markets following implementation of export controls by China, making the connection between the Chinese policy change and the financial stress even more explicit. The institution emphasized its well-capitalized status and regulatory compliance, while simultaneously explaining why it needed billions in additional liquidity. This paradox, reassuring stakeholders while accessing emergency funding, reflects the delicate position these banks found themselves in. They needed to communicate transparency without triggering panic among clients and counterparties. The third communication stood apart from the others in tone and audience. This was an internal message to staff rather than external communication to clients or counterparties. It announced that the institution had been granted expedited access to the Federal Reserve's discount window with a substantial approved credit limit. The discount window represents the Fed's emergency lending facility, traditionally used when banks cannot obtain funding through normal channels. The fact that this access was granted on an expedited basis underscores the urgency of the situation. Perhaps most tellingly, staff were instructed that no client-facing communications were required, suggesting a desire to manage information flow carefully to avoid triggering broader concerns. This internal-only communication reveals the gap between what institutions acknowledge privately and what they're willing to say publicly. These three institutions collectively accessed approximately $24 billion in emergency credit from the Federal Reserve in a single day. To put that number in perspective, this represents more emergency liquidity for precious metals market stress than the Fed has deployed in over a decade. The scale of intervention tells us that regulators viewed the situation as genuinely threatening to financial stability, not merely as isolated difficulties at individual institutions. When the Federal Reserve, which has seen countless market disruptions and trading crises, determines that $24 billion is necessary to stabilize three banks on a single day, that signals exceptional circumstances. The mechanics of what happened become clearer when examining the derivative positions likely held by these banks. Financial institutions use silver derivatives for various purposes, including hedging physical holdings, providing market liquidity to clients, and taking proprietary positions based on price expectations. Many analysts have long suspected that certain large banks maintain substantial short positions in silver, whether for legitimate hedging purposes or for more controversial market management objectives. When prices move dramatically against these short positions, the financial consequences accumulate rapidly. The leverage inherent in derivative positions means that relatively modest price moves can generate enormous gains or losses. Consider a bank short 10,000 silver futures contracts, with each contract representing 5,000 ounces. That's 50 million ounces of silver. If those positions were established when silver traded at $63 per ounce, and the price suddenly jumps to $84, the bank faces mark-to-market losses of $21 per ounce across 50 million ounces. That calculates to over $1 billion in losses for a single institution. Multiply that across three major banks with varying position sizes, and the combined losses easily reach multiple billions of dollars. These aren't theoretical losses or unrealized paper losses that might reverse. These are margin calls demanding immediate cash payments. But here's where the situation becomes even more complex. The $24 billion in credit facilities isn't just covering current losses, it's providing a buffer against future price movements. The Federal Reserve, in granting these credit lines, is essentially saying to these banks that they anticipate continued volatility and want to ensure the institutions have sufficient resources to weather additional adverse price moves. If the Fed thought this was a temporary spike that would quickly reverse, they wouldn't need to provide such substantial backstop funding. The size of these credit facilities reveals the Fed's assessment that this situation could deteriorate significantly before it improves. This forward-looking aspect of the intervention reveals the Fed's assessment of market dynamics. The Chinese export restrictions aren't temporary. They represent a fundamental shift in global silver supply flows, with approximately 400 million ounces per year potentially removed from Western markets. This supply shock cannot be easily offset, and its effects will compound over time as existing inventories get drawn down. The Fed clearly recognizes this, which explains why they're providing credit facilities sized to handle sustained stress rather than a brief disruption. They're preparing these institutions for a prolonged period of difficult market conditions. What we're witnessing is the collision between two distinct markets for silver. There's the paper market, where contracts are traded electronically, positions can be created through computer keystrokes, and physical delivery is rare. Then there's the physical market, where actual metal must be produced, transported, stored, and delivered to buyers who want the tangible asset. For years, these two markets have coexisted with occasional tension but general equilibrium. The Chinese export restrictions have severed that equilibrium, creating a scenario where paper prices cannot rise fast enough to reflect physical scarcity without destroying the financial institutions that maintain short positions in the paper market. The banks caught in this squeeze face an impossible dilemma. They need to reduce their short positions by buying back contracts, which requires them to bid up prices, but higher prices increase their losses on remaining short positions, triggering additional margin calls and requiring more emergency liquidity. It's a self-reinforcing cycle that becomes harder to escape the longer it continues. The Fed's credit facilities provide temporary relief, but they don't solve the underlying problem. At some point, these banks must exit their positions, and the act of exiting will itself drive prices higher, potentially triggering the very cascade failure the Fed intervention was meant to prevent. Market participants are beginning to recognize these dynamics, which is why we're seeing widening disconnects between different silver pricing indicators. Physical dealers are quoting prices 20 to 40% above futures market levels because they understand that obtaining actual metal has become increasingly difficult. Buyers willing to pay premium prices are securing inventory, while those trying to purchase at futures market prices find themselves unable to complete transactions. This bifurcation between paper and physical pricing is historically unusual and signals profound market dysfunction. When two prices exist for the same commodity, depending on whether you want actual delivery or just financial exposure, that's evidence of serious market stress. The implications extend beyond just the silver market. If major banks require Federal Reserve intervention to manage commodity derivative positions, what does that say about their risk management practices? What does it reveal about regulatory oversight that allowed such concentrated positions to accumulate? These questions have broader significance for financial system stability and the credibility of institutions that are supposed to be managing risk prudently. Banks are supposed to have stress testing, position limits, and oversight mechanisms that prevent exactly this type of crisis. Yet here we are, with three major institutions simultaneously requiring emergency support for the same type of exposure. Looking ahead to the coming weeks and months, several scenarios could unfold. In the best case, the banks use their Fed credit lines to gradually reduce short positions without causing dramatic price spikes. The Chinese export restrictions prove less disruptive than feared, and markets find a new equilibrium at higher price levels. In more pessimistic scenarios, the banks find themselves unable to exit positions without triggering runaway price increases. Additional margin calls exhaust their credit facilities, and the Fed faces political pressure over continued bailouts of institutions caught in losing bets. The middle ground between these extremes seems increasingly narrow. The most concerning scenario involves a complete breakdown of the paper, silver market's ability to function. If losses become severe enough, if delivery demands exceed available inventory, exchanges might invoke force majeure clauses and cash, settle outstanding contracts at arbitrary prices, while physical metal trades at substantially higher levels. Contract holders, expecting to receive metal, would instead receive cash payments that don't reflect true market value. This would represent the ultimate validation of the distinction between owning paper claims on silver versus owning physical metal itself. It would fundamentally alter how precious metals markets operate and how investors approach these assets. For individuals holding physical silver, these developments should be viewed through the lens of fundamental market dynamics rather than short-term price movements. If major financial institutions are experiencing such severe stress that they require emergency central bank support, that's evidence of genuine supply-demand imbalance, not temporary volatility. The Chinese export restrictions, combined with existing industrial demand and investment interest, have created conditions where physical silver is becoming increasingly scarce, while paper markets struggle to reflect that scarcity without triggering financial instability. This isn't speculation or theory. This is observable reality, confirmed by the actions of the Federal Reserve itself. The Federal Reserve's intervention on January 2nd represents a pivotal moment, not because it solved the underlying issues, but because it revealed how serious those issues have become. Central banks don't deploy billions in emergency credit lightly. They don't intervene unless they perceive genuine threats to financial stability. The fact that this intervention was necessary on the very first trading day after Chinese export restrictions took effect demonstrates how quickly market stress escalated and how vulnerable major financial institutions were to this supply shock. It also suggests that the Fed may have anticipated this moment, having established frameworks for emergency lending specifically for this type of scenario. What happens next depends partly on variables beyond anyone's control, including Chinese policy decisions, industrial demand patterns, and investment flows into precious metals. But it also depends on how long the Federal Reserve is willing and able to provide support to banks managing losing derivative positions. Every bailout has political costs. Every emergency credit facility draws scrutiny. At some point, either the banks successfully exit their positions or the cost of supporting them becomes untenable. Either way, the resolution will likely involve significantly higher silver prices than markets have historically experienced, as the fundamental supply-demand dynamics cannot be resolved without price adjustments that bring new supply online or reduce demand. The situation unfolding in precious metals markets represents more than just a trading opportunity or a market anomaly. It's a stress test of the modern financial system's ability to handle supply shocks in strategically important commodities. It's a confrontation between paper claims and physical reality. And it's a reminder that markets can remain functional right up until the moment they can't, when accumulated imbalances suddenly demand resolution in ways that catch most participants unprepared. The coming weeks will reveal whether the Federal Reserve's intervention bought enough time for an orderly resolution or merely delayed an inevitable reckoning.